Hello everyone, this is Marshall Gittler bringing you the morning comment for October 6th. Well, the dollar index surged to a 4-year high after Friday's strong employment report. I won't run through the numbers as they're well known by now. I'll just point out that the average of July, August, and September was around 224,000. That's not far off the 228,000 pace for the first half of the year. So hiring remains on a strong uptrend. The only weak point was the relatively small growth in average hourly earnings and the moderate decline in the participation rate. So the overall robust labor report adds to the growing body of evidence that the U.S. recovery is gaining momentum and should sustain the case for the Fed to raise interest rates next year. It isn't a game changer, though. The implied interest rates on Fed funds futures contracts are still lower than they were at the recent peak in the middle of September. However, the DXY index, the dollar index, has risen over that period. That suggests that more than just Fed expectations are at work here. One aspect is probably the widening divergence between the U.S. monetary policy outlook and that of other countries, as we've beaten that dead horse for a lot. But cable, sterling dollar, hit a low for the year on Friday, as did Aussie dollar. That demonstrates that the dollar is gaining even against the one other country that's also expected to tighten rates in the not-too-distant future, Britain. So where is the demand for dollars coming from? Well, we can get a hint of this by looking at the weekly Commitment of Traders report. In short, just to sum it up, speculators aren't opening up huge short positions in non-dollar currencies. That suggests that real money investors and corporate hedging has been leading the dollar's move up. That means to me that it likely has much further to go because these market participants have a continual need to hedge. Plus, it appears that the speculative community has yet to get on the bandwagon. So, from my point of view, the dollar upcycle is just beginning. As for today, the only indicator out today is the German factory orders for August. It's already out. It was weaker than expected at minus 5.7% month on month. This adds to the batch of weak data coming out from Germany, which is supposed to be the driving force of Europe. After that, we've got a quiet week ahead of us. There are 3 central bank meetings, but none is likely to produce any fireworks. The Reserve Bank of Australia meets tomorrow, and it'll be interesting to see what they have to say about their currency. The Reserve Bank of New Zealand recently put out a statement saying that the level of their currency was unjustified and unsustainable. And according to the OECD, the Australian dollar is even more overvalued than the New Zealand dollar. The Bank of Japan also meets on Tuesday. They'll probably just repeat that they're happy with the way things are going. Although, the Cabinet Office apparently is set to downgrade its view of the economy. Finally, the Bank of England meets Thursday. That's always not a non-event nowadays. The big thing then will be the release of the minutes of the recent FOMC meeting on Wednesday. We'll get some insight into why they left the commentary largely unchanged, even though they raised their interest rate forecasts. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.